Here's a sobering statistic that every crypto trader needs to understand. 90% of retail cryptocurrency traders lose money within their first year. But here's what's fascinating, it's not because they can't pick winning coins or read charts. The primary reason traders fail is poor risk management and position sizing. In the next 22 minutes, I'm going to teach you the professional risk management framework that institutional traders use to protect their capital and stay profitable long term. This isn't about getting rich quick, this is about building a sustainable trading approach that can weather any market condition. Before we dive into specific techniques, let's understand why risk management is the foundation of successful trading. Professional traders think about trading differently than retail traders. While retail traders focus on how much they can make, professionals focus first on how much they can lose. This mindset shift is crucial because in trading, you're going to be wrong frequently. Even the best traders are wrong 40-50% of the time. The difference is that they make more money when they're right than they lose when they're wrong, and they never risk enough on any single trade to seriously damage their account. Risk management isn't just a safety net, it's what allows you to stay in the game long enough for your edge to play out over hundreds of trades. Without proper risk management, even a profitable strategy will eventually lead to ruin through position sizing errors and emotional decision making. Professional risk management is built on several fundamental principles that work together to protect your capital. Principle number one, capital preservation comes first. Your primary job as a trader isn't to make money, it's to not lose money. This might sound backward, but once you accept this principle, everything else falls into place. You can't compound gains if you don't have capital to work with. Principle number two, risk per trade. Limits. Never risk more than you can afford to lose on any single position. The standard rule is 1 to 2% of your total account per trade, though this can be adjusted based on your experience level and risk tolerance. Principle number three, risk reward assessment. Before entering any trade, identify your potential profit target and your stop loss level. Professional traders typically look for trades that offer at least a 2.1 or 3.1 reward to risk ratio. Principle number four, position size correlation. The size of your position should be inversely related to the uncertainty of the outcome. High confidence trades can warrant slightly larger positions, while speculative trades should be much smaller. Principle number five, portfolio heat management. Monitor your total portfolio exposure at all times. Even if individual trades are properly sized, having too many correlated positions open simultaneously can create excessive portfolio risk. Now let's get into the specific calculations that professional traders use to determine exact position sizes. This isn't guesswork. There are precise formulas that remove emotion from the equation. The basic position sizing formula: position size slash account size x risk percentage, entry price, stop loss price. Let me break this down with a practical example. Account size $10,000, risk percentage 2%, $200 maximum loss. Entry price $50,000 Bitcoin. Stop loss $45,000, risk per unit $5,000. Position size each is $200, $5,000, 0.04 BTC. This means you would buy 0.04 Bitcoin, and if stopped out, you'd lose exactly $200, which is 2% of your account. The Kelly criterion for advanced sizing. For more sophisticated position sizing, some traders use the Kelly criterion F Site Dio BP Q Site B, where F finds fraction of capital to wager, B side tight odds received, reward to risk ratio, P tights probability of winning by probability of losing. This formula helps optimize position sizes based on your historical win rate and average risk reward ratios. Volatility adjusted position sizing. Cryptocurrency markets are highly volatile, so some traders adjust their position sizes based on recent price volatility. Higher volatility assets get smaller position sizes, and lower volatility assets can accommodate larger positions for the same risk level. A position sizing strategy is only as good as your stop loss discipline. Here are the main approaches professional traders use. Technical stop losses, based on chart levels like support and resistance, trend lines, or moving averages. These are objective levels where the technical thesis for the trade is invalidated. Percentage based stops, simple percentage drops from your entry point. For example, a 10% stop loss on any cryptocurrency position. This method is easy to implement but doesn't consider market structure. Volatility based stops, using indicators like average true range ATR to set stops based on normal price movement. This prevents getting stopped out by routine market noise. Time based stops, exiting positions if they haven't moved in your favor within a specified time frame. This prevents capital from being tied up in stagnant positions. Trailing stops, moving your stop loss in your favor as the trade progresses. This allows you to capture more profit during strong trending moves while still protecting against reversals. The key is choosing the appropriate stop loss method for each trade based on your analysis time frame, the asset's volatility characteristics, and current market conditions. Individual trade risk management is just the beginning. Professional traders also manage risk at the portfolio level to prevent correlated losses. Diversification principles: don't put all your capital into highly correlated assets. If you're trading multiple altcoins, understand that they often move together during market stress, effectively increasing your risk beyond what individual position sizes suggest. Maximum portfolio heat. Many professional traders limit their total portfolio risk to 6 to 10% across all open positions. This means if you're using 2% risk per trade, you wouldn't have more than 3 or 5 positions open simultaneously. Sector and market cap allocation. Consider spreading risk across different cryptocurrency sectors, DeFi, layer ones, meme coins, etc., and market capitalizations, large cap versus small cap, to reduce concentration risk. Correlation monitoring. Regularly assess how your positions move relative to each other and to Bitcoin. During market stress, correlations often increase, reducing the benefit of diversification. Cash management. Maintain adequate cash reserves for new opportunities and to avoid forced liquidations during drawdowns. Many professionals keep 20-30% of their portfolio in stablecoins or cash equivalents. Even with perfect mathematical models, risk management fails if you can't execute it consistently. Here are the psychological factors that derail most traders: position size, comfort zone. Your position size should be small enough that you can sleep peacefully at night. If you're constantly checking prices or feeling stressed about a position, it's probably too large. The martingale trap: never increase position sizes after losses to make back money faster. This is how accounts get blown up. Stick to your systematic approach regardless of recent performance. Overconfidence bias. After a series of winning trades, many traders increase their risk per trade. This is exactly when you should maintain discipline and stick to your proven system. Fear based undersizing. Conversely, after losses, some traders reduce position sizes so much that they can't generate meaningful returns. Find the right balance for your risk tolerance and stick with it. FOMO and revenge trading. FOMO and these emotional states lead to abandoning risk management rules. Develop systems and checklists to follow when emotions are running high. Every trader needs a personalized risk management plan. Here's how to create yours. Step 1: determine your risk tolerance. Be honest about how much volatility you can handle, both financially and emotionally. This varies greatly between individuals and should consider your income, expenses, investment timeline, and personality. Step 2: set your risk parameters. Risk per trade, typically 1 to 3% of account. Maximum portfolio heat, typically 6 so 12% of account. Maximum number of concurrent positions. Minimum risk reward ratios you'll accept. Step 3: choose your stop loss methods. Decide which stop loss approaches you'll use for different types of trades and market conditions. Be specific and write these rules down. Step 4: create position sizing spreadsheets. Build tools that automatically calculate your position sizes based on your rules. Remove the mental math and potential for errors during emotional trading moments. Step 5. Plan your review process. Schedule regular reviews of your risk management performance. Are you following your rules? What's working well? What needs adjustment? Let's examine the most frequent errors that destroy trading accounts. Mistake. Shira 1. Risking too much per trade. The fastest way to ruin is risking 5 to 10% per trade. A few bad trades in a row will devastate your account and psychological capital. Mistake number 2. Not using stop losses. Some traders avoid stops because they don't want to realize losses. This is like driving without a seatbelt. When something goes wrong, it goes very wrong. Mistake number 3. Moving stops against you. Once you set a stop loss, never move it further from your entry point. This destroys your risk management system and often leads to much larger losses. Mistake number 4. Ignoring. Correlation risk. Having 10 different altcoin positions might seem diversified, but if they all move together, you're essentially making one large bet. Mistake number 5. Emotional position. Sizing. Letting emotions dictate position sizes rather than following systematic rules leads to inconsistent results and eventual failure. Developing strong risk management skills is the foundation of successful crypto trading. Here's how to implement what you've learned. First, subscribe to this channel for more professional trading education content that focuses on sustainable approaches rather than get rich quick schemes. Second, I've created a comprehensive risk management toolkit that includes position sizing calculators, risk assessment worksheets, and a template for creating your personal risk management plan. You can download it free using the link in the description. Third, start small and practice these principles with paper trading or very small positions until they become second nature. Finally, comment below with your biggest risk management challenge. Whether it's calculating position sizes, setting appropriate stops, or managing emotions, I'll provide specific guidance in the replies. Remember, the goal isn't to never lose money. It's to lose money in a controlled, systematic way that allows your profitable trades to compound over time. Master risk management, and you'll be among the small percentage of traders who actually succeed in this market.